Mortgage delinquencies have dropped, and 2008 isn't coming back. Imagine this, it's 2008 all over again. Delinquencies on mortgage are spiking, foreclosures are flooding the market, and the economy is teetering on collapse. But snap out of it, because that's not today's reality. The latest data from the Mortgage Bankers Association shows mortgage delinquencies just dropped to 3.93% in Q2 of 2025. And stick around, because the next 7 minutes I'll break down what's really driving this drop and why it's not like 2008 at all, and how rising rental rates are actually strengthening this real estate market. No spin, just facts, context, and smart takeaways. So let's talk about what a mortgage delinquency really is. Somebody gets 30 days behind, they get a notice. 60 days behind, they become delinquent. But there is a long process between mortgage delinquency and foreclosure. See, the mortgage companies have a lot to do between the time that you miss your first payment and they actually foreclose on the property. And I'm actually a bit of an expert on this, because in 2010, I actually ran a mortgage modification company, and we helped thousands of people get mortgage modifications when nobody was willing to help them. We were one of 2 licensed in the state of Idaho to help people, and we help people all over the nation. But what happens is that the mortgage company in your documents has a very specific formula that they have to follow in order to take that property back. And that process takes a minimum of 9 months. Now, if you're somewhere like California, New York, that could literally be years. But what we're talking about is mortgage delinquencies. That means that maybe you've missed a payment or 2. Maybe you haven't been able to make the full payment. Maybe you lost your job for a couple of months and you've gotten behind, but you have the ability to catch up. And there comes a point when the mortgage company issues you a letter and says, hey, you have to pay the full amount by this date, or we're going to move forward with foreclosure. And that's really kind of the definition of where delinquency happens. And you can work out payment plans. They want to do a lot of different things, but this is very important. Now, when we're talking about delinquencies, the reason that this matters is because 3.9% of the mortgages that are issued are delinquent is not a very big number. In fact, even in all of 2008, it was still in the single digits what mortgage delinquency was. So when I look at this and I say, man, we are at near record lows on what delinquencies really are, we should be happy about that, because it means that most investors and people are current on their mortgage, and that means that the economy is strong, and we're not going to see a flood of inventory that's already been allocated to buyers, to owners, that's going to come back into the market. The other thing that we're not seeing is we're not seeing this led by investors. We're not seeing a lot of investors hand back the keys because they can't make the property pay for itself. So while investors may have been rubbing their hands together and licking their chops, thinking that mortgage delinquencies were going to become a problem, and this was going to allow prices to drop because of the flood of inventory, that's not likely to happen, because rates on that particular measurement are very, very low. So if you're an investor or a developer trying to avoid policy landmines like this, I put together a free resource you're going to want. It's called the SRI Due Diligence Framework, how we vet every single deal. And it walks you through how we analyze markets, risk factor, and policy red flags before deploying any capital into any market. And when I talk about policy red flags, it's like, what are the landlord laws? What are the things that are happening? Is there rent control? Those are the kind of policy red flags that we tend to stay away from, because we believe in free market and we believe that we actually own the assets. I know. Sometimes in some places on this planet, that is foreign. Grab it free at the link in the description and make sure that you can underwrite like we do. Everyone remembers the 2008 crash. What made this crisis so different from what we're seeing today? How are the post-2008 reforms like Dodd-Frank or stricter underwriting standards keeping the system more stable in 2025 than what we had in 2008? Well, let's connect the dots with rent growth. That is the key. Rising rents help prevent foreclosures or defaults. Now, this doesn't necessarily help the homeowner, but it helps us in the investor market. And when we saw the flood of inventory, this came into the market as investors were also buying. But when you had both of those factors coming, you now had too much inventory. And when investors have choices, Sometimes they pick neither. So this data really means that you can have a winning strategy in lending right now if you adjust your approach in just a few simple ways. So let's talk about the equity cushions that we like to build into deals and why today's average homeowner is in a stronger position than they were back in 2008. So if we look at it, over the last 5 years, we've had an astronomical rise in housing prices. With that, a lot of people locked into a sub 4%, even a sub 3% loan. In fact, I think the latest estimates say about 68% of homeowners have a sub 3% mortgage. Now, if you've ever looked at your amortization schedule, this shows you what you're getting toward the principal every time you make a payment. So if we look back, we've seen housing prices have continued to rise over 2018. So if you bought in 2020 and you paid a lot for the house, let's say you paid $350,000, that house has continued to move in the market to about $400,000. You're still locked in at a sub 3% interest rate, and that's giving you a fantastic amount of your payment that is actually going to principal. It's more like 60% going to principal and 40% going to interest rather than the other way around, and that adds up to thousands of dollars a year that you're actually putting at the principal involved in that mortgage. In 2008, people were doing completely the opposite. In fact, the adjustable rate mortgage, the ARMs that were very popular down back then, they even had something like a pick your own payment where you could buy a $500,000 house and the interest rate was going to be 8%. That wasn't what we were discussing, but we were going to allow you a period of 18 to 24 months that you could pick your own payment. Well, some people said, hey, I want a $2,000 payment on that $500,000 house at 8%. What was really happening was that payment was $5,000. So the mortgage company was stacking $3,000 a month on the back end of your loan. So if you bought that and you had a $500,000 mortgage, the next month you had a $503,000. By the end of the first year, you had a $536,000 mortgage that was now accruing at 8%. So you didn't have a $5,000 payment. You had a $5,300 payment that was adding onto the back. And so all of this was compounding. That is not happening now. They have changed that. They don't allow the mortgage companies to put buyers in those positions, which was a terrible, terrible thing to do. And it was borderline criminal if it wasn't criminal. So this is why we're not doing that. But a lot of people have what we call locked up equity. They've got something in there. They've got 50, 60, 70 grand in equity in their home. In fact, there are a lot of studies that are coming out that say that homeowners today have more equity in their home than ever before in history, but they can't get to it because the interest rate is not allowing that. If they were to go get a HELOC, they're going to take a HELOC out at 8-9%, and that's just not feasible for them. So what we see is completely different than what we saw in 2008, and the great news is, with mortgage delinquencies being low, it means that the buyers are staying put. So if this story shocked you, watch this next one. Portland just passed policies that could completely destroy its middle class and push thousands toward homelessness. Check here to see what's happening and what to do about it.